Now, welcome back to Strongman Personal Finance. Oh, yeah. Robinhood is going public. Am I going to YOLO my money? We shall see. Welcome back to Strongman Personal Finance. I am Christopher Bell, certified public accountant, long-term boglehead investor, author of the book Stop Being a Broke Loser, and loving and adoring fan of Meet Kevin, Jeremy Lefebvre, and others. Now, I'm excited to bring you information about Robinhood's impending initial public offering. That's right, ladies and gentlemen. Robinhood Stock is going to be publicly traded on the NASDAQ under the ticker symbol HOOD. I like that. Anyway, so what we're going to do today is we're going to talk a little bit about how IPOs have done historically, and then we're going to go look at Robinhood's offering statement. I'm pretty excited to bring this to you because I'm sure there's going to be a lot of fervor and excitement and media coverage, and I'm sure me and Kevin's going to tell you to YOLO all your money into Robinhood. Now, let's go check out historical returns of IPOs. Now, keep in mind, ladies and gentlemen, when a company goes public, usually that spells bad news for the average investor. Now, let's check this out. One of the most comprehensive studies of IPO returns was conducted by Jeremy Siegel at the Wharton School at the University of Pennsylvania. His study examined IPO returns of 9,000 stocks that went public since 1968. Blah, 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 blah. The findings may shock you, as IPOs were found to underperform the market by an average of 2 to 3% per year, with 4 out of 5 IPOs underperforming a small cap index. Of the 4 out of 5 that underperformed, half of them underperformed by more than 10% per year, more than a third underperformed by 20% per year, and approximately 1 in 6 underperformed by more than 30% per year. While all these odds may not be as bad as playing the lottery, they certainly they are certainly much worse than most other investments. So with that in mind, ladies and gentlemen, I want you to be aware that if you're going to buy into any IPO, you're probably going to get screwed, okay? And that includes Robinhood. So I don't care who's telling you what amazing potential Robinhood has, and I'm sure it's going to 100x, ladies and gentlemen. You need to be careful with IPOs because a lot of the times a company will IPO, it'll skyrocket, Coinbase, and then it'll freaking crash. So if you really are intrigued by Robinhood, I would take a breather, let the IPO happen, and then maybe if there's a massive dip, which there might be, maybe a couple days, weeks, months after the IPO, then you can consider buying into it. Now, let's go ahead and check out the offering circular, the offering statement, the Form S-1 registration statement that was filed by Robinhood Markets Incorporated. I didn't know it was Robinhood Markets. That's interesting. All right, so basically when you read an offering statement, you can get a ton of information about what the company plans to do. And it's important you read these things before you actually decide to invest in the company, okay? I don't care what it is. I don't care how exciting or futuristic it is. You want to go and look at these statements to know what you're buying. And you need to be especially careful because IPOs tend to suck. So let's go check out Robinhood. Let's jump to the table of contents. All right, so you know me. I like to look at the risk factors. So we're going to read the risk factors of investing in Robinhood. Risks related to our business. We have a limited operating history, which is difficult to evaluate our business and prospects and increases the risk associated with investment in our Class A common stock. Okay, that's basically a standard risk factor that every other company talks about. We have grown rapidly in recent years, and we have limited operating experience at our current scale of operations. If we are unable to manage our growth effectively, our financial performance may suffer and our brand and company culture may be harmed. Now, Robinhood's had a couple boo-boos, especially with that poor kid that killed himself because of a freaking glitch with his options account. You know, so, I mean, I don't know. Maybe Robinhood will have another event like that. Hopefully not. But they've been under fire before, and they probably will come under fire again because they are mainly focused on retail investors. And y'all know, I mean, I know all you retail investors think you're geniuses, especially if you started trading in 2020, but you're really not as smart as you think you are. We may not continue to grow, blah, 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 blah. I want to find more risk factors. We have incurred operating losses in the past and may not maintain profitability in the future. We have incurred operating losses each year since our inception in 2013 through 2019. Okay, so they haven't been profitable at an operating level for 5 years. And then I guess they started becoming more profitable as a huge frenzy erupted with retail trading. Remember, we're in a massive bull market right now, and there's tons of retail investors getting sucked in to trading options and stocks and even cryptocurrencies, okay? And I think one of the biggest risks with this company is that if there's a market downturn and a lot of people lose their money, you might see a lot of revenues go away from Robinhood, because Robinhood, like I said, attracts a bunch of new retail investors. That's like the majority of their client base. And if these people get burned, which I think they will eventually, if they're screwing around with options and cryptocurrencies, they might actually quit investing altogether. Or if they become more mature and a little bit older, they might consider other brokerages like Fidelity, Vanguard, T. Rowe Price, whatever. Because another big flaw with Robinhood is that their research platform sucks. It is not good. Now, I think they've been trying to improve it. Like they give you a little bit like ratings from Morningstar and stuff like that. But overall, I mean, if you want to do research on a stock and you want nice data, you might want to go to like Vanguard or even Fidelity. Fidelity has great information. Whereas Robinhood, I mean, you can kind of look at its expense ratio for a fund and they might show historical returns, but there's really not much there to really like slice and dice stocks. So keep that in mind and just really consider that in a future bear market, I think Robinhood will probably get hammered worse than most brokerages. Because a majority of our revenue is transaction-based, payment for order flow, reduced spreads in securities pricing, reduced levels of trading activity, generally, that's market downturn, changes in our business relationships with market makers, or any bans of payment for order flow, now that's actually come under attention too, and similar practices may result in reduced profitability, increased compliance costs, and expanded potential for negative publicity. Right, like I said, that's come under scrutiny before. Doesn't really bother me because I got to make money somehow, but if that comes under attack, Robinhood might be in some trouble there, okay? So we've looked at some of the risk factors, and you want to keep that in mind because every company has risks, okay? You can't just YOLO into a company unless you freaking read the information. So let's go ahead and jump back to the table of contents, and let's look at management's discussion and analysis. This is the management talking to you about what's going on with the company. And I like how Robinhood has all these like pretty beautiful, little pictures in their offering statement. It's pretty cool. So Robinhood was founded on the belief that everyone should be welcome to participate in our financial system. So here they kind of show, oh God. Oh, I hate when that happens. Every time I freaking zoom in and it jumps me to the wrong place. All right, so here they kind of show, looks like the growth in the number of customers. So you see, a decent amount of people in 2014, 2015, et cetera, were trading. And then you see this massive explosion in 2020 and 2021. Now, like I said, the reason that's happening is because a lot of people, they're seeing all these monster gains and options and stocks, and all these YouTubers are pumping all these ridiculous investments, AMC, GameStop. And that's attracting a ton of retail investors because Robinhood makes it super easy to just go on there and YOLO your money to whatever freaking stunk you want to, okay? That's one of the big flaws with Robinhood. And I don't think their growth is going to be sustainable, especially if we have a market downturn. So, I mean, just keeping that in mind, you need to be really careful if you buy this IPO, all right? So, let's see. All right, they just talk a little bit about their revenues, monthly active users, monthly revenues. Okay, so they're basically kind of like summarizing their financial information. But we're going to go ahead and look at their financial statements in a second. I just want to see if there's anything that's intriguing on here. Cumulative net deposits by annual cohort, key performance metrics. Okay, so they're basically just showing all their information. So let's go ahead and jump to their financial statements because that's really what matters at the end of the day. Is the company profitable? Is it growing in profits? Is operating cash flow growing? All that good stuff. So let's go ahead and check out the financial statements. So where are you? Robinhood. Where are you hiding your index to consolidated financial statements? All right. So the first thing we're going to look at is the balance sheet. Now, the balance sheet, there's a couple things you want to look at. You want to look at the current ratio, which is current assets divided by current liabilities. You want to look at any increases in debt. You want to look at stock issuances to see if there's share dilution. We may not see that because they're not even public yet. But generally, a growth company is going to be issuing more shares as it continues to grow. So the first thing we're going to look at is the current ratio. So what you do is you look at total current assets on the balance sheet, which in 2020 was $10 million, $10.8 million, divided by total current liabilities, 8.8. So as long as it's over 1, what that means is the company is not likely to go out of business anytime soon, or at least within a year. So that's a good thing, okay? Now let's go ahead and look at the liabilities, see what's going on here. Accounts payable and accrued expenses, payables to users, that's like banking. Securities loaned. Oh, wow. There was a huge jump in loan securities. I guess people are borrowing stocks to trade because you see here, securities loaned was 674,000. And then it went up to 1.9 million. So that's a lot. All right. So nothing too crazy here. Stockholders deficit, accumulated deficit. So an accumulated deficit is a company's profits or losses stacked up on each other. In this case, it's losses. If the company had profits, it would be called retained earnings. Here, it's an accumulated deficit. So as of 2019, they had an accumulated deficit of $196,000. Is this in thousands? It's in thousands. So $196 million. And then in 2020, they had an accumulated deficit of $190 million. So as they said, they've been running a ton of losses for the past couple of years. And only recently, because of this mad, speculative, crazy bull market, have they started to actually make a little bit more money, which I don't know if that's sustainable, but we'll see. So they currently have a accumulated deficit of $190 million. So they're still in the hole right now. All right. Let's see. Common stock. Have they been issuing stock? Looks like their number of stocks went down. That's interesting. Okay. Now, the next thing we're going to look at is their income statement because you want to look at the revenues, their expenses, see those trends, see what's going on. So in 2019, they had a total of $277 million in revenue, and that exploded to almost $1 billion in revenue. Now, where is most of this growth coming from? Transaction-based revenues. So you see they had $170 million in 2019. And then because all these young kids are throwing their money in here, trading options and crap, their transaction revenue went up, what is that, 4 or 5x to $720 million. All right. And they also make interest revenue and other revenues. Now we want to look at their expenses. So they have brokerage and transaction expenses. They have technology and development. Okay, so they're basically spending a lot more money on tech and development. It's not necessarily a bad thing. Marketing went up by, $50 million. General and administrative. So I don't see any real crazy changes here. I mean, it kind of makes sense that their marketing is going to be increasing and that they're going to be investing money in technology and development because they're a growing business. Now, you want to look at their operating income, other expense, income loss before income tax. So in 2019, they had a loss of $107 million. That was before the crazy speculative bull market. And then in 2020, with all these clowns trading money, they had a profit of $13 million. Okay. And then you factor in net income. All right. So they had a pretty big loss. And after taxes and all that stuff, they made a profit of $7 million, $7.5 million. Nothing crazy, especially if you look at the earnings per share. They made 1 cent of earnings per share. Okay. I don't know what they're going to IPO at, but 1 cent earnings per share seems extremely low to me. But we'll see what happens. Okay. So that is their income statement. Now let's go ahead and look at their statement of cash flows. So they have net cash provided by operating activities. This is actually a better thing. I actually don't mind this that much because you see their net cash provided by operating activities was $1.2 million in 2019. Even though they had a loss on the accrual basis of accounting, you got to remember with the accrual basis of accounting, they're expensing stuff when expenses are incurred, not when cash is paid. And they're recording revenues when they're earned, not when the cash is received. So if you look at it from the cash perspective, they made $1.2 billion in operating cash flow in 2019, and that went up to $1.8 billion in 2020. That's decent growth, but like I said, always keep in mind, if there's a downturn and all these retail investors stop investing in this company, I don't know. All right. So we'll look at investing activities. Okay. They're purchasing property, software, and equipment. So they definitely have pretty healthy free cash flow, which is a good thing so far. Financing activities, okay. It looks like they borrowed almost $1 billion on credit facilities, proceeds from issuance of redeemable convertible preferred stock. Now, convertible preferred stock is important to note because a preferred stock has seniority over common stock. Preferred stocks are basically like a combination of a bond and a stock where they don't have an expiration date and they pay a periodic payment out to the holder of the preferred stock. However, this is a convertible preferred stock. What that means is those preferred stocks can be converted into shares of common stock, which would dilute the shareholders, the common shareholders of the company. So you want to keep in mind, you want to look and see if they're issuing convertible bonds, convertible stocks, and you need to factor that in and really understand if you're going to be significantly diluted into the future. Because if the common stock does rocket up, you're probably going to see a lot of conversions from preferred stock into common stock, which dilutes you, okay? So not necessarily bad. I don't hate the stock right now, but I'm personally not going to buy into the IPO just because we all know what IPOs do. They shoot up and they freaking crash. And to me, it's just too early to invest in this company. I want to see how this company does when all the retail traders experience a bear market. Because once they do that, you might see a different story in their revenue growth. Now, I did see somewhere they kind of broke down what their revenues came from. And it was pretty surprising because a lot of it came from options trading. But I need to freaking find that first. Here we go. Disaggregation of revenue. So this is important. You want to see not just what the revenues are, but what specific revenues or what is generating the specific revenues. So for transaction-based revenues, you see significant growth in options revenues from 110 million in 2019 to 440 million in 2020. That's pretty significant growth, okay? And options definitely dominate their revenue. Options are highly speculative, and in a bear market, I think a lot of people are going to lose a lot of money, and they're maybe going to be turned off from options. So that's a big risk factor there, all right? Then you have trading in equities, that's stocks, went from 50 million, so it 5x'd in 1 year. Pretty crazy. Cryptocurrencies, decent growth, 2.5x in 1 year. And then other revenues. I don't know what that is. All right. So the vast majority of their revenues come from transaction revenues, specifically options and stocks. Cryptocurrencies, I think they're trying to invest more into like developing cryptocurrency section of their platform, which is cool. That's fine. And that's why I like this company more than Coinbase, okay? Coinbase is just cryptocurrency, at least to my understanding. Whereas Robinhood is like, okay, we have options, equities, and cryptocurrencies. So if you're going to choose between Coinbase or Robin stock, I would go with Robin stock, but I'm not saying to buy it, all right? And then they have interest revenues, securities lending. Wow, look how much that exploded. It went from 6.3 million in 2019 to almost 100 million in 2020. So they're definitely lending securities because people are borrowing money. Margin interest, 20 million in 2019 to 66 million. Margin, yeah. Wonder what's going to happen to margin traders when the stock market goes down. Interest on aggregate segregated cash and securities. Okay, that went down pretty significantly. Other interest revenue. So most of their interest revenue is from securities lending and margin. So I don't know. I'm not comfortable investing in this company, especially after an IPO. And you really want to see, a decent amount of revenue and a decent amount of quarters of profitability and continued growth. Now, if there's a bear market and the company doesn't just collapse when all the retail investors, flood away, okay, maybe you can consider investing in the company. But as of right now, I would not recommend you buy into this IPO. There's too much madness. And all the clowns on YouTube, me, Kevin, and probably Jeremy LaFufu, Stockmo, Keenan Grace, all these clowns are going to be pumping this stock. And that's probably going to lead to a massive run up right after the IPO, and then probably a freaking quick dump right afterwards. So that's kind of my quick analysis of the Robin stock offering. Not as bad as like some of these other stocks, but I don't know. Holy crap, we got a lot of comments. Kevin said he would buy Robinhood IPO like he did with the Coinbase. Of course he is. He's Meet Kevin. I saw Robinhood Men in Tights. I love Men in Tights. Market downturn will be in October. I mean, you can't really predict downturns, but Like I said, let's see what happens to Robinhood and all the money they're making from options, which is their vast majority of their revenues. Let's see what happens when all these retail investors get freaking burned. No way, strong man. Strong man. Let's hear some Palantir thoughts. I mean, I did a video on Palantir earlier. I don't like the stock. I did see a commercial of Palantir. It's pretty funny. So I'm watching YouTube and a freaking Palantir advertisement comes on. I'm like, why is Palantir advertising to me? I'm not going to buy their services, okay? The only thing I can think of is they're trying to entice me to invest in their stock. But I was like, oh, I don't think I'm a target demographic for Palantir advertisements. Palantir, great long-term stock to own. I mean, I did a video. I thought it was just bleeding cash. I mean, I want to see profitability and consistent profitability before I invest. That's what I was thinking, David. Can't hate on Palantir and Daddy Carp. What is Carp? That's what COVID did from stimulus check and with short interest margin calls. Yeah, I mean, if the context of that comment was, you know, how Robinhood's revenues have exploded, I mean, I agree. It's like stimmy checks, retail investors, you know, jumping into the stock market to make a quick buck, which is why I'm worried that Robinhood might not be as sustainable as people think, because retail investors don't really know what's coming. I mean, they've only lived through a massive speculative, you know, frantic bull market. But the second these retail investors, you know, they see the stocks go down 20, 30, 40, 50%, they might crap their pants and just give up on investing. Or they might grow up a little bit and, you know, use brokerages like Fidelity, like I do. I mean, Robinhood, I don't mind the interface, but for long-term investing, they don't have a Roth IRA. I prefer to have a, you know, a more standard broker like Fidelity. You love the stimmy free money. Everybody loves printed money. It's not free money. Everyone's paying for it. Yep, that's inflation. Avoid some taxes. Will strong man read the chat? That's what I'm doing, bro. Put your money in a Roth IRA. Exactly. That's one of my criticisms of Robinhood is they don't have any tax advantage accounts. So all these people are jumping onto the craze and they're trading securities and they're paying massive taxes, short-term capital gains. I don't know. Whatever. I only trade options and important assets like new cars. All right, geez. There's so many freaking comments. Can y'all summarize them into like fewer comments? I am the only one in the chat that likes buying VT index. For the other two people in chat like gambling. Yeah, I mean, I think you're going to be fine, screw college. Especially, I don't know how old you are, but if you buy VT in a tax advantage account, dollar cost average, max them out. In 20 or 30 years, you'd be surprised how much money you have. Okay, that's basically all I've been investing in is VT, and Big Daddy Strongman's doing pretty well. Holy crap. What's the best place to start my Roth IRA? I mean, whatever brokerage you like. There's no, I like Fidelity, but you don't have to use Fidelity. October stocks will tank. Bills will have to be paid. I like your hat. Yeah, it's actually a play on Jeremy Lefufu, but hopefully some of you got that. Anyway, so to conclude this video, I have to go downstairs and burp the baby or something. Don't buy into the Robinhood IPO, okay? I don't know if the revenue growth is sustainable. And historically, like I read that article, IPOs, people that buy into IPOs get freaking crushed. And you saw like a ton of IPOs vastly underperform the market. So it's better to sit back, wait, see how Robinhood does in a bear market, and then consider, okay, since their revenues may be sustainable in a bear market, maybe then I'll consider buying into it at the right price. Take your shirt off and flex strong, man. You got to pay me, buddy. $20. Tell the family good luck with T-Hark. All right, that's it. Don't buy the Robinhood Stock IPO. And for the love of God, don't listen to me, Kevin. Anyway, y'all have a wonderful, delicious night. Oh, if you haven't already, if you're a new viewer, subscribe to my channel. Tell your friends about me. Talk to you later.